We're here today on RealAgriculture.com. We're with Todd Hirsch. He is the senior economist with ATB Financial. Welcome today, Todd.
Hi, Sean.
Todd, we're going to talk about something that is really on the minds of farmers, something that is, I guess, it's not a question of if, it's a question of when. It's rising interest rates. How concerned do you think that farmers should be about rising interest rates?
Well, rising interest rates are always going to be on the minds of farmers and all Canadians. And we do know that we're in an environment where those rates are going to be going up. The real question is how quickly and how much will those rates be rising. The answer to that question, interestingly, has changed over the last 4 or 5 months. Probably back in early spring, it was a little bit clearer that interest rates were going to be rising, and actually quite quickly. The Bank of Canada was suggesting that rate increases are coming in June of 2010, and they're going to be consistent throughout the rest of 2010 and into 2011. But now the global situation has changed on the Bank of Canada. We're seeing a lot of volatility in markets and commodities. We're seeing a lot of volatility in currency markets. And as a result, the Bank of Canada is taking a much more guarded approach to suggesting how quickly rates are going to be rising. So in other words, rates are still going to be going up, but probably a little more slowly now than it looked like they would have been maybe 4 or 5 months ago.
Well, I think a lot of the concern about this has to do with, and I've heard George Brinkman before comment on the fact that Canadian farmers are significantly more leveraged than American farmers for a number of reasons. So there is a lot of talk about this. We've heard a lot, I've heard a few consultants or people giving, keynote addresses say that, start to move some of your debt into more fixed rates instead of floating. But that's very difficult for farmers considering there's still quite a premium difference.
It is, yeah.
Yeah, go ahead.
It is difficult. It is difficult for farmers to do that, and even the decision, should I be moving it from floating to fixed or even vice versa, really depends on that individual farmer situation, the amount of debt that he or she is carrying at the moment, and exactly what their plans for expansion are.
So we've been hearing lots about the double dip possible scenario in the U.S. What's kind of the outlook for Canada right now? You said that the global situation has changed. We don't think rates are going to go up as quickly as we first thought. What's kind of the comments on the global or the Canadian economy specifically?
Well, for Canada, the prospect of a double-dip recession is much slimmer than it is in the United States. The U.S. economy, it's looking pretty shaky right now. The indicators that we track, they're sort of pointing helter-skelter in all directions. So one morning, some indicator will be showing good growth, and then the very next day, something will be really disappointing, pointing in the opposite direction. So the U.S. economy is kind of on thin ice right now. I would still say the probability of a double-dip recession for the United States is still only maybe 25%. With a 75% chance of something looking like very flat growth. For the Canadian economy, obviously what happens south of the border affects us here, and if they do in fact go into another recession in the United States, that will certainly affect Canada. Although our situation in Canada, we are in better shape. We did not see a housing correction like they've seen in the United States, and our banks are in much, much better shape than they are in the U.S. And it really has been those two key pieces, the housing market and the weakness in the banking and financial sector, that has hit the U.S. economy. So it still leaves the Canadian economy in better shape. I'm quite confident at this point that Canada is not headed for a double-dip recession in 2010 or even in 2011. And that will keep the Bank of Canada sort of still wanting to move those rates higher, but probably at a slower pace.
Well, and I guess it's my opinion that, and if you look at exchange rates, we can deal with a change in exchange rates if that change is slow. Same with interest rates, right? If it happens over a long period of time, you have lots of time to adapt, especially in a business environment. When there's rapid change, that's where it becomes very, very difficult. And we saw that with the Canadian dollar when it went from like 67 cents to a par in a very, relatively a very short time period. So if we are going to see that slow rise in interest rates, what is your analysis taking in terms of what number should we be thinking about? Like I've heard some people say, today's generation won't be able to deal with 10% again. Like, could we honestly see 10%?
That's a good question. If there was any lesson from 2008, I guess the lesson is never say never. So I don't want to, we will never see 10% interest rates again, but we won't be seeing them anytime real soon. We're still at generational low interest rates, even with the Bank of Canada and the bond market, wanting to push those interest rates a little bit higher. We're still going to be in an environment of extremely low interest rates for the next 2 or 3 years. Anything past 3 years, say in the 5 to 10 year horizon, anything is possible. Mortgage rates certainly, they could be back up at 10%. Probably not in the 20% range like we saw in the early 1980s. It all depends on the outlook for inflation, how tolerant the U.S. economy particularly will be of higher inflation, and how that inflation may spill into here in Canada.
Okay. So Todd, I guess to wrap up here, if you were a farmer or if you were talking to a group of farmers, what kind of recommendation would you give to farmers in terms of thinking or handling or dealing with interest rates and managing the debt on the farm?
I guess I would suggest that, they really do want to be getting some professional advice on it. And advice, is going to be very different depending on the individual farmer and that exactly their business model, how much their debt they're carrying now, what their plans are for the future. So it really varies. But in a general sense, I would advise them that, rates are going to be going probably gradually, but we can be looking forward to at least 100 to 150 basis point increase across the yield curve, across that interest rate curve over the next 12 months. So, whatever adjustments they might need to make, 150 basis points isn't really a whole lot. It will still be, keeping those interest rates at pretty low levels, but it will be higher. So they will have to be thinking about what they're going to be doing next.
Todd, well, thank you very much for joining us today, and hopefully we'll talk to you again soon in the future.
Thank you very much, Sean.